to Money Confidence. I'm Crystal Oculee. I'm the Chief Financial Strategist here at Confidence Wealth. And every week I bring up topics that have been talked about and what I believe is important and things for you to, just look at and things that you may have thought about. So let's go ahead and talk about diversification, because that's something I've been hearing a lot about. So diversification is obviously one of the most important things you would do, because you don't want your assets, your net worth, to be heavy in one sector versus others. You create different buckets for different times, and you create different strategies within each of those buckets. Now, there are times that I see people that their form of diversification is having multiple financial advisors. So what happens is, let's say they're working with 3 different people in 3 different banks and firms. And unfortunately, what majority of the time happens is not actually true diversification, because they believe that this advisor may have a different philosophy versus this advisor. But the truth of the matter is, it's not just about the philosophy. It is also about those pieces, and let's call them furniture, your investments. Those are the furnitures that you're purchasing for your house. Think about your house as that foundation, your house as your plan, right? So imagine you wanted to decorate your home. Will you buy the furniture without knowing how your home layout looks like? That would not look very right, because what if you bought a couch that's too big for the family room? What if you bought a dining room table that's too big? That's the reason why most people wait till they know what the house looks like, if they built it or bought it, and then they buy the furniture that goes within that house. Then you set everything else up, right? You make sure all the different things in your house are running properly, whether it's the plumbing, whether it's water, electricity, all of those different things. So again, I'm bringing this down to a basic way that I want you to look at your plan. So your plan is the same as when you think about your house, your financial plan. The foundation, all of that is, how does your house need to look like? What types of rooms does it need? How many rooms does it need? Then you start buying the furnitures, which are the investments within those houses. And then all the other stuff like tax planning and all of that will relate to making sure the household is running. In the example that I said, is the plumbing right? Is the electricity running? Is the water running? That would be example, looking at different tax strategies. Are you maximizing Social Security? Is all the different things set up? Is your estate plan set up the right way? So why I brought this up is, imagine if you have your house and you decide that you're going to have 3 different interior designers designing the rooms, because they have different looks and different feel, different looks, and you want to get that different feel. Now, right hand doesn't know what the left hand is doing. They could come back with, literally, one of them could make one room into a guest room, and the other one would do the same thing because they wanted to do the guest room, and then maybe you're repeating the same type of holdings. And really, they don't even match each other in the right way, and they're not working harmoniously together, because that would be too many cooks in the kitchen and not a harmonious way that is getting managed and put where now everything is working well together. Well, investments are the same. Sometimes this happens when you have multiple different advisors. What they're doing is they're also buying these different furnitures to have for those rooms. Sometimes you're repeating the same furniture. Now you end up having 4 different couch where you didn't really intend to do that. So in your portfolio, maybe you go heavier in the sectors. You all of a sudden are too heavy in the financial sector, or you're too heavy in technology, and you're repeating the same type of holdings. So when the market goes down, the whole portfolio drops in the same way. So what that is called is stock intersection. Stock intersection means how many different, let's say, for example, you're holding 10 different mutual funds. What type of holdings you're holding within that, and are you repeating the same thing? So example, a Fidelity advisor may be holding a Fidelity targeted fund, where a Vanguard one is holding a Vanguard targeted fund, but they both have the same ingredients, maybe just a little bit differently, but pretty darn close. So that's the reason why we find a lot of times where people think of diversification, they're not looking at it from a holistic approach, because that's what they have to look at and really understand multiple different advisors. Sometimes it's too many cooks in the kitchen and can actually cause an issue. Now, let's also look at other types of diversification. So what if you're heavy in real estate and you don't have enough on cash, you don't have enough on maybe the market side? So with that said, then you're just heavy in one particular asset. And if something bad happens, that asset drops. So I want you to just look that as you plan your retirement, one of the most important things, and this is what current clients already experience with us, so you already know this, that you're looking at all the different things, all the different buckets. So then you have different types of assets and you're not repeating the same types of assets. So then that way, let's just say you got real estate, you got your market side, you got your protected side, you got your fixed income, you got your pension, you got your bond, you got your social security. You have all these different types of way that maybe income is coming and different asset strategies. So then that way, one drop is not going to affect all of those at the same time. That's what true diversification means. And what's really important is that you need to make sure, again, think of as your holdings at the furniture of your house. Not only they need to work well together, but they also, you can't repeat the same thing. You can't put the same couch you put in your living room in your family room, right? Maybe the formal room and the family room. It would be crazy, right? It would be the same look. So that doesn't make any sense. So in the same way, you want to look at your actual investment holdings in the same manner that you want to really watch out and make sure they're properly diversified and you don't have too many cooks in the kitchen as well. Because afterwards, you got to look at the investment plan, which is where the holistic planning comes into play. So again, food for thought. I wanted you to think about this. Current clients, as you know, this is something we do on a regular basis, is we're meeting, looking at the holistic approach. If you're friends or family of clients and you're watching this, so important to really understand what's happening in all the different assets and buckets in your net worth and making sure you're truly diversified so you don't have to worry about, short-term volatility, because you don't want to have one bad market crash determine the success of your portfolio. Hopefully this has helped. If you have any question on diversification or you just want to know how else can I make my portfolio more diversified, or I want to run a stock intersection on my 401k that I have at work and I don't know if I'm repeating the same things and things like that, don't hesitate to reach out to us. Until next time, have a good one.